Gold just hit $5,400 an ounce. And the number isn't the story. The story is what that number means. Gold doesn't move because of war. It moves because people stop trusting everything else. And when I look at where gold is today, and more importantly why it's there, I see a warning signal that the financial world is still trying to decode. I've watched gold make 4 major moves in my lifetime. 1973, 1979, 2008, 2020. Every single time most people chase the price and ask the wrong question. They asked, how high can gold go? The right question is always, what is gold telling you about everything else? Answer that and you understand not just gold, but what comes next, including something nobody is watching right now, something geographically closer to American soil than most people realize. Let me start with a number that actually changes everything. Not gold's price, a different number entirely. 800 tons. That's how much gold central banks around the world are forecast to purchase in 2026. Poland, the Czech Republic, China, all officially adding to their gold reserves this year at one of the fastest paces ever recorded. And that number comes from official sector data, not speculation. When central banks buy gold, they're making a specific statement. They're saying, we trust physical metal more than we trust the paper promises of other governments. They're diversifying away from the US dollar. Not dramatically, not all at once, but consistently, quietly, month after month, quarter after quarter. On top of that, U.S. gold ETFs, investment funds that track the gold price, have seen $10.5 billion in fresh inflows this year alone. Investors across America are pulling money out of equities and rotating it into gold. Not retail speculators. Institutional money. The kind that moves slowly and deliberately. The kind that was already moving into gold before the first bomb fell on Iran. JP Morgan published a research note this week with a formal $6,300 per ounce price target for gold by the end of 2026. Goldman Sachs has an $18 per barrel war premium already embedded in oil prices. And their own commodity desk noted that if the Strait of Hormuz disruption extends, gold could surge an additional 12 to 18% above current levels. Here's the thing most investors miss about all of this. Gold doesn't rise because it's fashionable. It doesn't rise because YouTube channels are excited about it. Gold rises because confidence in everything else is falling. Dollar confidence, government reliability, the integrity of paper money systems. When that confidence fractures, even partially, even temporarily, the one asset that has held value for 5,000 years becomes the destination for scared capital. The scale of money moving into gold right now tells you something profound about where institutional confidence currently sits. I call this the confidence collapse. Not a crash, not a catastrophe. A slow, measurable, documented decline in the faith that money managers, governments, and central banks place in paper systems. The confidence collapse doesn't announce itself on the news. It shows up in the gold price. And right now it's showing up louder than it has since 1979. The 1979 parallel is real, but most people are explaining it wrong. Let me give you the full picture. In 1979, gold sat at roughly $250 per ounce in early January. By January 1980, it had climbed to $850. A 240% surge in approximately 12 months. That remains one of the single greatest gold price movements in modern financial history. Most people tell that story as, Iran revolution happened, things got scary, gold went up. That's not wrong, but it's incomplete. And the incomplete version misses the reason why it matters right now. Here's the full picture. In 1979, 3 things happened simultaneously. First, the Iranian Revolution cut Iranian oil output by 7 million barrels per day, creating an immediate global energy shock. Second, U.S. inflation was running at 11.3%. The Fed had allowed it to spiral for years while trying to protect growth. Third, the U.S. dollar's credibility was genuinely in question. The world was asking whether America could control its own monetary system. Those 3 forces, energy shock, inflation out of control, and dollar credibility crisis, hit at the same moment. Gold didn't just benefit from fear. It benefited from structural loss of confidence in the most fundamental financial institutions on earth. Now look at March 2026. Iranian oil has been disrupted. The Strait of Hormuz has effectively closed, not because of a blockade, but because shipping insurers pulled coverage and tanker operators pulled their ships. Global inflation, which the Fed spent 5 years fighting back toward 2%, is now being pushed upward again by surging oil and natural gas prices. And the US dollar, while still the world's reserve currency, is facing the same quiet question it faced in 1979. Can the government manage this? Is the monetary system still reliable? This is not a carbon copy of 1979. Gold was coming from $250 then. It's coming from $5,100 now. The scale is different. The context is different. But the three-part trigger, energy shock, inflation reacceleration, confidence question, is present and measurable in a way it hasn't been since Jimmy Carter was in the White House. The World Gold Council found that gold has averaged 8.98% gains over 12 months following major conflict events. Not guaranteed, not every time, but consistent enough to be structural rather than coincidental. And this conflict is not a contained regional skirmish. This is the United States at direct military war with Iran, a country that sits astride one of the most critical shipping corridors in the world economy. The scale of this event is categorically different from Yemen or Syria. Markets are treating it differently. They should. Now here is the third lesson, the one nobody is developing properly. The next domino. Everyone is watching Iran. Everyone is watching the Strait of Hormuz. But the people who understand history, energy, and strategic geography know that the story rarely ends where it started. And right now, there is a country 90 miles from the coast of Florida that is quietly moving toward a crisis that almost nobody in financial media is covering. Here's how the connection works. Cuba has been entirely dependent on subsidized oil arrangements, first from the Soviet Union for decades, then from Venezuela under Hugo Chavez, and then continuing under Nicolás Maduro. Venezuela ships heavily discounted crude to Cuba in exchange for Cuban professionals, doctors, military advisors, intelligence personnel. It's a barter arrangement that has kept Cuba's economy and energy system barely functional for 20 years. Now look at what the Trump administration has done systematically. Venezuela's oil exports have been targeted by U.S. sanctions. The Venezuelan operation in January 2026 tightened the vise further. The flow of discounted Venezuelan crude to Cuba, already reduced significantly, is under sustained and escalating pressure. Cuba is already experiencing severe fuel shortages. Blackouts lasting 16 to 20 hours a day have been reported in Havana and across the island. The government has struggled to pay for oil on the open market. Their foreign currency reserves have been depleted. And now, with the United States prosecuting a full war in the Middle East, with oil prices spiking globally, and with geopolitical energy disruption at levels not seen since the 1970s, the prospect of Cuba sourcing replacement oil from anywhere becomes even more remote and expensive. Here is why this matters to investors and to markets specifically. Cuba sits in the Caribbean, adjacent to key shipping lanes connecting the U.S. Gulf Coast to the Atlantic. It sits near strategic naval choke points that matter to American military and energy logistics. When a country 90 miles from Florida experiences an energy collapse and political instability simultaneously, as happened during the Cuban Missile Crisis of 1962, as nearly happened during Cuba's special period in the early 1990s after Soviet collapse, the United States cannot simply look away. Geopolitical risk doesn't stay contained. Energy stress is a multiplier. It amplifies political instability, migration pressure, and military calculations simultaneously. The Trump administration is already managing Iran, managing Venezuela, managing trade tensions. A Cuban crisis landing on top of all of that is not a prediction. It's a risk that is currently unpriced in most portfolios. And what does unpriced geopolitical risk mean for gold? The confidence collapse deepens. Capital flows accelerate into the assets that have no counterparty risk, no government behind them, no promise attached to them, no institution that can fail and take them down with it. Gold was the asset people reached for in 1962 during the Cuban Missile Crisis. Gold was the asset in 1979. Gold is the asset right now. The geography has changed. The logic is not. I've spent this video telling you what gold is signaling and why the next domino could fall closer to home than anyone is discussing. But I built my entire reputation on saying this. Understanding without action is just expensive entertainment. So here are 3 specific things, starting today. The first thing is to establish a proper safe haven position if you don't already have one. I'm not saying convert your savings to gold. I never have believed in that approach. Gold produces no earnings. It pays no dividend. It doesn't build anything. But a 5 to 10% allocation to a gold-backed investment serves a specific portfolio function. It provides partial insulation when confidence in paper systems declines, exactly as it's declining right now. For U.S. investors, Geld or Real, gold ETFs accessible through a standard brokerage or a Roth IRA give you this exposure efficiently with daily liquidity. For UK investors, gold ETCs inside a stocks and shares ISA mean any gains are completely tax-free. Set it up this week. It takes under 10 minutes. The second thing, look at energy sector exposure. The Cuba angle, the Strait disruption, the sustained oil shock, all of these create a period where energy producer revenues rise. An energy sector ETF through your existing account puts you on the right side of that equation. When petrol prices rise and you feel it in your wallet, you want to also feel it in your portfolio as a gain, not just a loss. Not a huge allocation. 5% is enough to provide meaningful balance. The third thing, and this is the one that takes the most discipline, write down your ceiling price now, before the market gets more volatile. Decide today, at what price would you take profits on gold exposure? At what price would you exit an energy position? The investors who got hurt most badly during gold's collapse after 1980, when gold fell from $850 back to $300 over the following years, were the ones who had no exit strategy. They rode the move up and then rode it all the way back down. Because when gold is rising and every headline confirms your decision, nobody rings a bell at the top. You have to decide in advance, not in the moment, now. Your future self will either thank you for the discipline you showed in a week like this one, or wonder why you had all the information and still let emotion make the decision. Save this video, because the situation in Iran and Cuba and in gold markets will keep developing, and the confidence collapse framework I've given you today applies to every stage of what comes next. Subscribe to Warren Buffett University for the financial thinking that actually protects and builds wealth in moments like these. Gold price 2026 forecast. Iran war gold surge. 1979 gold parallel. Cuba next crisis. Strait of Hormuz gold impact. Central bank gold buying 2026. JP Morgan $6,300 gold target. Oil shock inflation investing. How to invest in gold safely. Gold ETF Roth IRA strategy. Stocks and shares ISA gold. Smart money safe haven rotation. What gold price means for dollar. Geopolitical risk portfolio protection. Why gold is rising right now. The people who built real wealth through the crises of the last 60 years weren't the ones who predicted the future. They were the ones who understood the signal and acted on it before the crowd did. You've just heard the signal. Clearly, now you decide what you become.